Hello and welcome to the Business Standard Morning Show. I'm Veenu Sandhu. It's the 25th of September 2023 and here are the questions we will be answering today. What's weighing down Akasa Air? Will you pay for Twitter? What next after JP Morgan Index inclusion? And what do household net financial savings mean? Just over a year after taking off, Akasa Air has hit turbulence. It had to cancel several flights after over 40 pilots pressed the eject button recently. Reports of fund crunch are also doing the rounds, but the budget carrier looks unperturbed. It has moved the Delhi High Court seeking action against the pilots and is planning to double their strength. So exactly what is going on in the airline, which was a dream project of late billionaire investor Rakesh Jhunjhunwala? Ayush Mishra finds out.
Ace trader and the big bull of Dalal Street, Rakesh Jhunjhunwala, loved challenges. He flagged off Akasa Air's maiden flight between Mumbai and Ahmedabad on August 7, 2022, when the world was still recovering from the blows of the pandemic, and the airline industry was mired in turbulent weather. But Jhunjhunwala, being Jhunjhunwala, saw clear skies ahead. He infused $200 million into the airline and got it registered as SNV Aviation. But as soon as the airline took to air, Jhunjhunwala breathed his last at 62. While mourning his demise, Vinay Dubey, the founder and CEO of Akasa Air, thanked Jhunjhunwala for being an early believer and putting his trust and faith in the airline. Dubey had then asserted that Akasa Air will honor Jhunjhunwala's legacy and values by striving to run a great airline. Late Rakesh Jhunjhunwala and wife own about a 46% stake in the airline. Its CEO, Dubey, has a 16% stake. In the last 1 year, the fledgling budget carrier rapidly expanded its wings. It became the fastest to get to a fleet of 20 aircraft, a prerequisite to operate international flights. On its anniversary, Akasa claimed that it was operating 900 flights a week, and it plans to go global by December 2023. But some alleged that the airline poached distressed pilots during its rapid expansion from struggling SpiceJet and grounded Jet Airways at less than market rates. Recently, Akasa moved Delhi High Court after 43 pilots quit the airline. In its submission, its counsels claimed that the airline was in a crisis and may be forced to cease its operations, and that it has been cancelling 24 flights a day in September. But CEO Dubey claimed a day later that the airline's future and growth path were intact. Out of the total strength of 20, Akasa Airline has 19 Boeing 737 MAX 8 and one Boeing 737 MAX 200.
The issue of the 737 MAX is also very important to understand here, because globally across the world, the total number of pilots on the 737 MAX is 1/10 of what the pilots are on the 737 NG and the Airbus A320, correct? We know that. Now, when the MAXs already have such a small pilot pool base, Akasa knew very well when they signed up for these aircraft from Boeing, and if I might add, Akasa got an outstanding deal when, figuratively, in comparison, if the aircraft costs 100, Akasa got it for 23. Right? Now, you got the cheap aircraft. You know very well this aircraft is constantly having issues and problems. Globally across the world, pilots are increasingly not willing to fly this aircraft because of now recently discovered rudder issues with the MAX. And you're fully aware of all these risks and you went ahead and started an airline. What was Akasa doing when it came to manpower and human resource planning? Why couldn't they get the pilots? Why couldn't they get engineers? So this is just nothing. What this case appears, it appears to be a last-ditch effort to cover up an otherwise very clear goof up by Akasa.
Interestingly, till August, the airline's order book had 80 jets, including 23 Boeing 737-8s and 57 Boeing 737-8-200 aircraft, which are set to be delivered in 5 years.
The pilot shortages actually might be visible from next fiscal onwards when all the grounded aircraft are back in air, they get operational, and also induction of new aircraft gets normalized. So the challenge will become more perhaps going forward in the next fiscal. And hopefully by that time, airlines will start looking at this matter more seriously and try and see if they need to increase their hold pools or look at other business practices to ensure that they have sufficient number of pilots when the aircraft are out in the air. But insofar as Akasa is concerned, we don't think that there's a case where the airline is going to shut down. These are regular sort of demand supply mismatches, if I were to put it like that. And there are ways and means of overcoming these issues.
The Ministry of Aviation recently granted Akasa Airline permission to launch international flights, opening up new opportunities for growth. Its CEO, Vinay Dubey, said that the airline is on track to announce a 3-digit aircraft order by the end of this year to serve the growing travel demand. On the issue of pilots, an Akasa Airline spokesperson recently told a business news portal that it has a team of over 450 pilots, and another 60 pilots are expected to join after completing their notice periods at other airlines, and that the airline plans to double its current pilot strength. He also termed flight cancellations as only short-term constraints. Now, only time will tell if the airline meets Jhunjhunwala's expectations or not.
Social media platform X, which was formerly called Twitter, has also been facing turbulent weather since its takeover by Elon Musk in October last year. His dramatic entry into Twitter's headquarters is still fresh in people's minds. So is the blue tick verified accounts saga, and later the name change. And now Musk is toying with yet another idea to turn the platform into a paid site. If that were to happen, will you pay for it? Abhijit Kumar does a reality check.
After a lot of noise across the globe over X, formerly known as Twitter, the micro-blogging platform is back on headlines. This time, it is the subscription fee. During a live-streamed event with Israeli Prime Minister Benjamin Netanyahu recently, Elon Musk said that X is moving towards introducing a small monthly fee for using the platform. The move, he said, is aimed to keep the increasing number of bots off the platform. Let us understand from Nikhil Pahwa of Medianama, is it a wise move?
That this will have negative effects, that some users might choose not to pay, and so therefore the value in the platform could also go down. It's his call, it's his platform, right? He's responsible for its financials.
However, a paywall for simply using the services in the garb of getting rid of bots might not sit well with the users. Amol Kulkarni of Cuts International believes the cost-benefit analysis of the platform fee might not work for many users.
We need to realize that currently consumers are paying Twitter by their data. So Twitter is collecting consumers' data and it is selling to advertisers, and then on the top of it, consumers would be required to pay. It's a large a part of users who use Twitter currently for educational, income generation, and other such use cases may feel that Twitter has become unaffordable or the cost-benefit analysis does not work. It might also lead to increase in malicious actors who are able to pay and misrepresent themselves as some other.
Media observers believe that many brands use bots to further their advertising and social media reach. The move might force the brands and advertisers to leave the platform and switch to X's contemporaries like Blue Sky, Mastodon, and the indigenous platform Coup. X has historically grappled with the issue of bot armies and misinformation campaigns on its platform. So, is a subscription service the only way to take on bot armies?
Twitter has an ability to identify what are the geographies from which such accounts are originating, what are the texts such accounts are using, what are the IP addresses from such bot accounts are sort of being used. So there could be many other ways to discourage bots from being prominent. Charging users is not necessarily a practical move in my sense.
While tech majors like Google and Meta have chosen technical solutions like machine learning and content moderation to combat similar problems, Musk's idea of paywall might be indicative of further monetizing of the platform. However, it is tough to determine the financial state of the company since it no longer files financial reports. Twitter recorded $5.1 billion in revenue in FY21, the last full year when it declared its financial results. It hadn't booked profit since 2019 and posted loss in 8 years of the past decade. This financial opaqueness following Musk's takeover of X has only led experts to speculate. Musk believes that by making users pay, X can potentially arrest the growth of fake accounts on the platform. It can be a potential strategy to diversify revenue streams beyond just advertising.
In terms of Twitter's business, one doesn't know whether they are in the profit right now or not, right? Because after Elon Musk took it private, they actually started charging for verified users. Advertisers also, I believe, reduced advertising on the platform. So it's no longer a public company, so we don't know how its finances currently are.
As Twitter explores the possibility of a paywall, the company is at a crossroads, balancing the need for revenue diversification, battling bot armies, and sustaining user engagement. The decision, although still in pipeline, may shape the future of the popular social media platform.
Thanks to Musk, the lives of X users have turned eventful. For Indian investors too, things have been rather exciting. Last week was eventful for the Indian markets. While equities took a hit on the bearish US Fed commentary and the India-Canada rift, bond markets cheered the inclusion of domestic debt securities to the JP Morgan Emerging Market Index. So what's on the cards for the Indian financial markets this week? Harshita Singh and Rex Cano find out in this report.
Domestic financial markets woke up to a significantly positive development last Friday as India made the cut to JP Morgan's Global Bond Index. Starting June 2024, Indian government securities will be part of JP Morgan's widely tracked Government Bond Index Emerging Markets. The development, which is expected to lead to foreign inflows of up to $30 billion, lifted India 10-year bonds in early Friday trade, with the yield dropping to a near 2-month low. The Indian currency also eased pressure and moved closer to the 82 per dollar mark. Experts say that the liquidity gush will support the bond markets in the near term, though most of it has been factored in.
Now, after this announcement, and as and when gradually the index inflation actually happens from June 24 onwards, and the weightage gradually increases from 1% towards 10%, which have indicated for India, inflows will come in. So one is inflows from passive investors abroad, those FPIs abroad who passively follow the index, and also from active investors of that psychological impact that now India is part of the index. So they also should come into that investment. The market has already mostly reacted because the market was kind of expecting it. Now it has actually happened, and the market has already reacted. Some more positive reaction may happen. Yields may come down a little bit more, but not too much of an incremental distance because the market was kind of anticipating it.
Analysts at Citi expect the development to boost demand for Indian debt among foreign investors and push the 10-year bond yield down to 6.8% in coming months. This will likely result in lower yields on corporate bonds too and ease overall borrowing costs, which in turn will benefit rate-sensitive and leveraged Indian companies, experts add. As for the equity market this week, stock-specific action and Thursday's monthly FNO expiry will be in focus. Market sentiment, however, will be bearish after last week's losses due to a hawkish US Fed policy outlook and rising India-Canada tensions.
The Canadian funds which are invested in India, I mean, they're quite a lot. I mean, they have totally, I suspect, about $25 to $30 billion invested in India. So they have not started withdrawing. So this is only in the fear that something like that may happen. So therefore, if that indeed starts working out, that the way the fears are, then I think it can correct quite a bit. So we have to keep our fingers crossed, see how new developments occur, especially on the international front, the war front. As of now, the mood doesn't seem to be particularly good, so I expect markets to continue to correct a bit.
Technically, the Sensex index this week will find support near 65,250 to 64,800 range. Nifty's support could be around 19,600 to 19,700, while on the upside, its gains could be capped at 20,050. Thus, any progress on Canada and India's diplomatic strife will be key to easing pressure off equities ahead. Today, on September 25th, prices of crude oil and global market trends will dictate mood back home.
He's making plans for an early retirement. Business Standard.
But not all is well outside the glitter of the Lal Street. Soaring inflation and the near stagnant income is hitting the common man hard. Household savings have fallen to nearly 5-decade lows, according to a recent report by the Reserve Bank of India. But what do net household financial savings mean, and why are they important? Abhijit Kumar explains in our next report.
A recent Reserve Bank of India data showed that the household net financial savings rate is at its lowest in about 5 decades, standing at a 5.1% of gross domestic product in financial year 2022 to 2023, compared to 7.2% of GDP in 2021 to 2022. But what are household net financial savings? Household net financial savings, or household savings, are crucial economic indicators that measure the financial resources a household has left after deducting its expenses and taxes from its total income during a specific period. This concept is essential for understanding the financial health and stability of individual households and can also provide insights into broader economic trends. Household net financial savings are calculated by taking the total income of a household, which includes wages, salaries, rental income, interest, dividends, and other sources of earnings, and subtracting all the expenses and taxes that the household incurs over a given period. If the calculation results in a positive value, it indicates that the household has saved money during the specified period. Positive savings can be used for investments, building an emergency fund, or other financial goals. On the other hand, if the result is negative, it signifies that the household spent more money than it earned, potentially leading to a debt accumulation. Household net financial savings are crucial for several reasons, such as financial stability and investment strengths of a household. On a macroeconomic level, it is an important economic indicator which gives an insight into consumer sentiment and spending. Household savings are influenced by various factors, including income levels, employment stability, financial literacy, and government policies.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Some experts claim that the dip in net financial savings of households also suggests the likely transience of the post-pandemic rise in consumption. Well, that's all for today. For more news and analysis, please log into our website business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.